Hey, it's Bill Gross, the LA probate expert, with our market update for the week. And is the market going to boom again next year? Is the market going to fall apart next year and crash? You see headlines in the real estate industry on both sides. And I would say to you, probably not. Probably it's going to be more of the same when we look at the data. And that's what I like to do. So let's take a look at the data together and see why I believe the market is going to be a solid year next year of growth, but not the wild ride that's being predicted. So that said, let's go to the screen. And first, I just want to share real estate. The realtor.com shows housing forecast a whirlwind year for buyers is ahead. So they're now predicting not just a year, a busy year, a good year for buyers or a good year from sellers, but they're predicting a whirlwind year. And I think that's part of the challenge here is that we make these exaggerated claims that scare buyers and scare sellers. And in reality, let's look at the data. So the first thing of data we should look at, I think, is foreclosures, because you've heard over and over again, there's going to be a tidal wave of foreclosures. Is there going to be? So let's take a look at the active forbearance market. Forbearance is when there's programs by lenders to work with the borrowers to help them out of the problem. And you can see right post pandemic, we had almost 5 million people who were late and needed help from FHA loans, Fannie Freddie loans, and other loans. And over time, that steadily declined, where today the total, all of them together, the total is about a little bit less than a million when we were almost at 5 million before. So they're down about 80%. 80% of the people who had pandemic induced problems and got approved for a program for that are back on track in about 20% or less. Now, it's true, difficult to foreclose. There's a mess in the county court system, particularly here in Los Angeles. And I'm not saying it's going to be all bed of roses and unicorns and rainbows. I am saying, though, that that tidal wave that we thought about and talked about for a year has really, for the most part, gone down to a much smaller, more manageable wave. Now, the next factor driving the market is rents, because if people can't afford, if rents go up higher, that will obviously drive buyers to buy properties. It also makes things good for investors to buy property as they get better income. So will rents go up or not? Well, let's take a look at the data. And you can see year over year, it has skyrocketed with no real letdown in sight. What that means is that people who are living in houses, living in houses or apartments, living in units, where their payments are going up at inflationary rates, 5%, 10% in some markets, are going to say, hey, let's get together and buy a property. Or they'll buy a house and rent out rooms to people. And investors will continue to buy houses if they can rent to people who afford to pay higher rents. Now, there is a change in our market, in the marketplace, where people are more agreeable now than ever to rent. A higher income people, upper middle income, lower upper income people, particularly young tech employees, are more comfortable paying $3,000, $4,000 a month in rent or higher. And we don't have a real stock of inventory for those people. So that is being built in the marketplace currently and driving a lot of these big apartment buildings being built, particularly in Texas and Florida and some of these other expanding markets. But if rents go up, you're going to see increased demand for property continuing, because people can both afford for the same amount to own a house, or the step up isn't as much, and investors will get such a good return. So now the real driving factor is, well, how about inventory? Because in order to have falling prices, you have to have more houses for sale than you will buyers. Is that true? No, not even close. In fact, here's an amazing graph that compares this year with last year and the year before. And you can see that as tight as inventory was in 2019, we talked about it. It got tighter in 2020 and is way tighter today in 2021. No let up in sight. In fact, look at the data and you can see that the market today is still down 30, 40% from 2 years ago, when we talked about tight inventory every single day limiting the market. Now, what does this mean? A couple factors. Obviously, sellers that own a house, want to buy a house, are having, if there's limited inventory, they may not find what they like and therefore may not sell their home. Well, that's not as common as you would think, because people who are moving often will rent for a year, or they'll buy a new home, or they'll buy a higher price home. And the market's a little easier in higher price markets than mid price markets. So it's not really the constraint that has been in years past. That's how we've had declining markets and increasing sales. The other thing is the increased amount of off market inventory going to sales. whether it be iBuyers like Zillow and Open Doors. And as a realtor, I would say more and more of my business are off market sales where people want to sell a property, don't go on the market, and it gets sold. So it looks like lower inventory, but the house is already sold. There's more and more of that with technology and with the market that we're in today. So declining, but here's the key thing. As long as inventory is declining, you cannot have a housing market crash. The only way there can be a crash is for the inventory to rise above normal levels, above normal demand levels. And you can see from this graph, it's just going down and dropping at an increasing rate of pay. So the next question that people talk about is, well, are housing prices affordable? Can people continue to afford to buy houses? What happens when it gets out of their price range? And what I would say, and I saw a great article confirming this, is that housing affordability is about as much as it's been overall time. And here's a statistic that shows that. This is taking affordability based on not on the traditional, the house as a percentage of one's income, because if one's income is a certain level, but the rates go down, the payment goes down, you can afford more house. As a realtor, that's the number one factor driving the market, is that for the same monthly payment, people can afford more house. And you can look by this graph that other than a few bumps, we're kind of in the fat, meaty, normal market part of where affordability is. So it's not highly affordable like we were pre-crash in the 80s and pre-crash in 2002, 7, 8. It's in the nice average kind of market it's been over the last couple of years. But here's the key point. Is that good or bad? Well, actually, by historical standards, that's great news, because when the market has been moderately affordable or harder, that's when there's been price appreciation. Here's the 5-year real price appreciation curve in red and the affordability in blue. And you can see that whenever the blue goes up, the appreciation goes down. And you can see that when the blue goes up, housing more affordable, the return on houses is down, meaning when everybody can buy a house, they're not going to go up in price. When it's a little harder to afford, housing prices go up dramatically. And so while affordability is, by historical standards, I would say moderate or a little bit tighter than moderate, you can see that creates good opportunity for those people who can get together and buy a property because they stand to get great appreciation over the long run. So housing affordability, really not a problem. What's all that mean? Well, somebody who then would say to me, oh my gosh, so how about interest rates? It is true. The government is spending more money than ever. It's true by historical standards that would cause perhaps greater pressures on inflation. It might be true that inflation is now at higher rates than being publicly declared. But the reality is that we have some built-in room before the housing market will react. People assume that a 1 or 2% interest rate will collapse the market. And it's not true. Let's take a look at recent history, 2017 and 18, where you had rates in the 4 and 5% and the market continued. Now, these are new home sales, which are traditionally more reflective to interest rates because home builders have to borrow money for a period of time to buy the land and to build the house before they can sell it. And they're considered to be the most affected by interest rates. And you can see that over time, we had in 2017, rising rates did not destroy the market. 2017, 18 were about the same. The underlying economy was a bigger factor than the moderate rise of interest rates. So then go back again to the graph. It's so affordable. If rates do go up to 4 or 5%, it won't be as affordable, but that would be perhaps a great opportunity for investors to get a better return. So what does all this mean at the end of the day to you as a prospective investor? Well, or home buyer? What I would say is I don't have a crystal ball. Maybe we go to war. Maybe we have some sort of global calamity like we had pandemic 2 years ago. Maybe some other thing happens. But based on the facts right now, in my 36-year career in real estate, there has never been a better time to buy or sell. And how can they both be? Well, for sellers, you can get a great price right now, but most importantly, great terms. Typically, sellers are selling to get into another property, and that's a difficult transition. It's never been easier. They've never had more leverage to get the timing they want and the terms they want. And buyers, as long as you can lock in a great interest rate, and that's the key. You have to have your loan lined up and be ready to lock in with your loan contingencies. If you can lock in today's rates below 3%, slightly above 3% for 30 years, you're going to have a great payment on a house that you're going to choose and a great hedge against any potential inflation. So if I can help you, call me, text me, email me. I'm Bill Gross, bill at the laprobateexpert.com, or see me in social media, YouTube, Facebook, LinkedIn. I'm at Bill EXP. If I can help you, please reach out. Make today your best